Hello, hello. Today we're going to be taking a look at two different dividend stocks. We're going to be looking at Verizon and AT&T and see which we think is the better buy today, as well as how we think one or both of these could fit into your dividend or dividend growth portfolio. There's a lot of recent news with these two. Verizon, ticker symbol VZ, recently was picked up by Berkshire Hathaway to much news, and then was dumped subsequently later in a spree of further buys by the firm. AT&T recently spun off their Warner Media business, cut its dividend, and then refocused the company on its core businesses like wireless. Warren Buffett says it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. I like to take inspiration from this quote when designing scoring systems for different stock portfolios. And so the first thing that we'll look at today is 5 different quality measures for each of these two stocks. And then we'll look at value measures, another 5. And then we will do some qualitative scrutinizing of each stocks before figuring out how we feel about them in total. Let's look at our quality score sheet first. The first thing up is return on invested capital, and specifically we'll be using the 5-year average return on invested capital. So return on invested capital is a company's ability to reinvest its profits in itself to further growth. So a higher number here means a company is better at it, and it is a really great symbol for companies that are able to sustain growth over long periods of time. The second quality metric we'll use, I call the DMC number. Really, it's the Chowder score, which is a company's dividend yield plus the 5-year dividend growth rate. But I look at the payout yield instead of the dividend yield. So the difference here is I look at dividends paid plus buybacks instead of just dividends paid. That said, since buybacks tend to fluctuate a lot from year to year, up and down, I cap the amount of credit that we give a given stock from buybacks. It won't apply in this case, but it's good to know for next time. Third, I look at the payout ratio. So what percentage of the company's cash flow is needed to cover the dividend. It's important that this is safe and that there's enough runway for the company to continue growing its dividend over time. Fourth, we have its projected sales growth rate. So we know a lot of core stuff about how the company is managed in these first 3. We want to make sure that the company is actually projected to grow in the future. And we don't necessarily need massive growth projections because we think a strong ROIC will show us that over time, but we want to make sure it's projected to grow. Fifth, we want to know how strong the company's competitive advantages are. This is also known as a moat. This is another Buffett favorite, something you can find on Morningstar. It's a really important way of looking at how sustainable a company's competitive advantages are because we want to buy and hold stocks for a long time. And lastly, we'll look at capital allocation. So how strong is management with their balance sheet? And the hope here is with these 6 metrics, we can get a really great idea of what a company looks like and whether or not it is a really high quality company. So let's jump in and look at our first one for AT&T and Verizon. Return on invested capital. So we're looking at that 5-year average return on invested capital. Verizon, we've got 13.6. This is a little bit above market average, right around market average. It's good. Nothing spectacular, but it's good. AT&T, on the other hand, comes in extremely low, 6.4%. And it's well below market average. It's estimated that it would be about 9% for its wireless business. So if you look at that specifically, it's a little bit higher, still under the market. However, there's a lot to think of here. Management's been making a lot of bad investments that haven't paid off, acquiring companies like Warner Media. And also, with the streamlining and the spin-off of the company, it's likely that this is going to change a lot in the future. So you do have to put a little bit of a star next to this one for AT&T. It's probably going to get better. That said, management hasn't done a great job applying their cash in the past to these acquisitions. So how much better will it get? Do we think it's going to be good enough? These are all really risky questions that you have to be pretty confident on if you want to invest here. So we're going to give that first point to Verizon. Next, we're going to look at that forward yield plus buybacks plus 5-year dividend growth rate. And ideally, the higher the better. We'd love to see numbers around 10, 15, ideally. However, for Verizon, we've got a 7.3. It's pretty poor. They've got a great dividend payout. They're not buying back stocks. That said, they're not really issuing them either. They're coming out about even every year. But they're not really growing their dividend much either. AT&T comes in even lower, 6.5. So it's tough to say what this will be post-split. So right now, their dividend payout, their dividend forward yields are about the same, with Verizon having a 2.1 growth rate and AT&T having a 1.1 growth rate. AT&T did shed some debt and obviously cut the dividend in the spinoff, so it's possible they'll be able to grow faster going forward. So again, a lot of these AT&T numbers, you end up with that little asterisk, like, well, post-spinoff, it'll be better. I have trouble with the rose-colored glasses for AT&T just because it's the same management that has been making mistakes for so long that we have to trust to make things better going forward. So again, we're going to give a point here to Verizon. Now we're going to look at payout ratio. So Verizon comes in at 47%. That's quite good. And AT&T comes in at 56%. That's also fine. Technically, Verizon's a little bit better here, but we're going to just call this one a draw. They're both under 60%. It's just not a whole lot to worry about in my mind. Okay, projected growth. This is another tough one. We're going to look at what is the projected average growth over 5 years based on an average of different analyst estimates. So for Verizon, we've got a 3% growth rate. It's pretty low, but it's still growing. For AT&T, we've got a 2%. Also very low, also growing. Unclear exactly what that'll look like when it's just their core businesses. We're going to give the nod to Verizon here. These two are close, but it is, it's one absolute number apart, but it's also a 50% difference. So for here, I think for that much of a difference and how much uncertainty there is in AT&T's business at this time, I feel comfortable giving the point to Verizon. Let's look at economic moats. They both come in at narrow. So this is fine. Wide moats are really exciting to see. Narrow moats just mean that the company doesn't have quite that durable economic advantage. In this sort of space, you can think, well, people like Verizon. Maybe some people like Verizon or AT&T more than the other one, but they're not, they don't have a diehard loyalty to the product like they do, like iPhone users do, for example. They've got that narrow moat. They've got sustainable competitive advantages, but not insurmountable sustainable competitive advantages. So we'll split this point. And capital allocation. So I pulled this from Morningstar. It's one of my favorite metrics to look at to see how good of a job is management doing. Verizon's got standard. That's the normal rating. It's acceptable. AT&T is poor. I view this as pretty worrisome. It doesn't really surprise me. I've touched on it a couple times already in this video, but AT&T has made a bunch of really bad acquisitions over the years, so it doesn't surprise me to see this be a poor rating. The hope here is that these same executives can turn it around in a more focused business and do a better job, but there's a lot of history working against them. So again, we're going to give that last point to Verizon. So totaling up our quality summary, we've got Verizon taking 5 out of 6 points and AT&T taking 1 out of the 6 points. So out of our first run through, it really looks like Verizon's the strong winner here. But this is only one side of the picture, so we want to take a look at value as well. And we will jump into that now. So, our price or value score sheet. We're going to look at PEGI. So this is, so most people have heard of price to earnings. And most people have heard of the PEG ratio, or price to earnings over growth. With dividend companies, I like to look at price to earnings over growth plus payout yield. So you'll look at their PE ratio and then divide that by their projected 5-year growth rate plus their payout yield. Analyst fair value. So this is the average analyst fair value. I take analyst estimates from a number of different firms to try to get a good picture, make sure that they're recent estimates, that they factor in recent news and they're not, outdated, etc., and try to get an idea based on that. We look at the dividend discount model. This one I vary based on the given stock I'm looking at, but for Verizon and AT&T, I think dividend discount model is a good proxy here. I look at their EV over EBITDA versus their 5-year average, basically just saying compared to how they usually trade or have traded over the last 5 years, how are they trading today? I do a discounted cash flow. So this is a bit of a objective analysis. You make some assumptions about things like growth and profitability, and then you project what is the discounted value, discounted to today, what is the value of all of the future cash flows. And then we'll also look at dividend yield theory, which is basically the idea that a company's dividend yield will revert to its mean. So if it is above the mean, it is likely undervalued. If it's below the mean, it's likely overvalued. Okay, let's jump in. Peggy, you can already see here, this one's a draw. Verizon comes in at a 1.11. AT&T comes in at 1.04. Again, they're both nicely valued, close to 1. But neither of them are real standouts from each other. They're very close together. Analyst fair value, average of 3 estimates. Again, we're going to look really similar here. Verizon's at $59, AT&T's at $25. It's respectively 17 and 18% undervalued from today's price. So based on analyst estimates, they're both quite undervalued. So they're going to split that point as well. With the dividend discount model, Verizon has it at $32 and AT&T has it at $12.50. So interestingly, this says they're both quite overpriced at 35 and 39% from today's value. Their EV over EBITDA, Verizon looks fairly valued, and AT&T looks about 20% undervalued. So this is the first one where they're really standing far apart in my mind, and we're going to give that point to AT&T. It is trading significantly below its 5-year EV to EBITDA, where Verizon's just sort of been hanging in the same spot. Next, we'll look at discounted cash flow and see what that's going to tell us. Verizon, again, appears fairly valued based on the 10-year DCF. And again, similar to the last point, AT&T appears significantly undervalued at 17% under. So we've got a nice second win for AT&T here. Moving on to yield theory. This one's going to be a little tricky. Verizon's fairly valued. It's right around where it always has been in the last 5 years. AT&T looks overvalued. This is the biggest asterisk because they cut the dividend based on a spinoff. This is not based on price trends and a consistent dividend. However, we still have to give the point to Verizon here. And so for our price summary, we've got 2.5 points for Verizon out of 6 and 3.5 for AT&T, showing AT&T is the better priced of the two, with Verizon having been the more wonderful of the two. Before we get into the next part, I always like to bring up this Peter Lynch quote, so know what you own and why you own it. I think what I want to get across here is it's not just enough to do a quantitative evaluation of stocks. So you may agree with the quantitative measures that I just ran through. You may disagree, you may have your own, or you may be developing your own. But regardless, it's very important when you're going to buy a company to hold for a very long time that you do more digging than this. And so I have a step in my process that I like to call scrutinizing, and that's what we're going to dig into next, which is just to try to pull a few pluses and minuses for each of these stocks qualitatively to weigh against the numbers. Let's take a look at Verizon first. So, number one, they're the market leader. They're number one in wireless, and they have been for a very long time. Second, it's safer. So, rule number one in investing is don't lose money. Verizon has a lot fewer question marks around it than AT&T does. And third, it's boring. It's not really exciting. It doesn't have that turnaround potential that AT&T does. The whole wireless industry has potential tailwinds from 5G rollout. We've yet to really see what that's going to look like financially for the companies outside of the amount of money that they've been shelling out for spectrum. And so Verizon just looks like a slow, steady, dividend turtle. Moving on to AT&T. Well, the risk versus reward. There's more potential for both. So we've got this management team that's failed in the past, but they've recognized that and they've set the company up for a different future. And that gives the company a bit more runway to look exciting even without substantial changes to the market itself. So, they may benefit similarly from 5G tailwinds to Verizon, but they could also benefit from just streamlined business operations and a focus on what they're doing in a way that Verizon can't. That said, they can also flop and fall on their faces as their management team continues to make mistakes. So higher risk, higher reward. They're focused. They offloaded debt and distractions. Debt is a big, scary part of this industry as all of the big providers accumulate massive amounts of debt to acquire spectrum. And so AT&T leveraging down its debt is great. And in addition to having offloaded some of it in the Warner Media spinoff, they've also made a public commitment to paying it down, which is an exciting nod for shareholders. And third, they're committed to improved capital allocation. So the company knows that they've done a bad job with investments, they've done a bad job managing their debt, and they have a commitment to their shareholders that they're going to do better. Are those just words? Yes. On the other hand, not everybody is giving those words. There's not a public commitment from Verizon that they're going to aggressively pay down their debt or make sure that they're going to streamline their business and make sure that it's operating at peak efficiency. So I think when management makes these kind of claims, it's really interesting. I would tend to view this as a good thing. However, management's failures in the past certainly bring up, should you trust them or not? And for the final verdict, so I think there's a few things here. One, for a sort of retirement-esque portfolio where you're just trying to get a very high yield, I think that either or both of these could have a place in a diversified portfolio. For a dividend growth portfolio where you're attempting to optimize total returns over time and really grow your payout over time, I don't think either of these warrant a significant position. I have a category in my dividend growth portfolio that I call speculative, which has a maximum of a 1% allocation. And that's sort of where I would put these. For me, I lean towards the safer of the two in Verizon. So I would certainly give the nod between Verizon and AT&T to Verizon. And I have it as a 1% allocation in my portfolio. But it's definitely on shaky ground. I don't do a lot of trading, so my main foundational and core positions are things I'm looking to hold forever. And that speculative place is where I tend to play around here and there over the years. And Verizon's not one that I feel particularly great about, though the yield is quite nice and it has been a really robust company for a long time. So with that, let me know in the comments what you think of these two stocks. The yield is really attractive, but the growth in the dividend and the growth in the businesses is a little scary for me. I'm curious what your thoughts are. Let me know in the comments below. Thanks.